Thank you so much, Tracy. I'm so happy to be here with my partner in crime, Debbie Katie. Just some background. I'm a financial advisor and certified divorce financial analyst. And as you can imagine, with all the cases I work on, particularly with women, the question is, should I rent? Can I stay in my home? Should I buy a place? And Debbie is a fabulous mortgage lender and consultant mortgage banker, and she often helps me solve problems for my clients. So I'm very appreciative she's here today. So I'm going to go through these slides here, and we're going to start with who is this webinar for? Well, we wanted to talk about when you are purchasing a home on your own, and you may be a first-time home buyer, or many of you may be not a first-time home buyer, but this is the first time you're purchasing a home on your own or refinancing a mortgage on your own after divorce or potentially death of a spouse. So we are breaking this webinar into two parts. Today, we are going to be talking about the basics, the financial literacy of what goes into a mortgage. What are some of the main issues you need to consider? And then next week, same time, same bat channel, we are going to actually go into a little more advanced issues, some case studies. And Debbie, this is one of the reasons why you really should work with an experienced mortgage professional, because some of these things are not easy. You've got to think outside the box. And we're going to be talking about different case studies and different advanced tips, but we want everyone to have a level playing field of the basics. So let's just, Debbie's going to do most of the talking today. I'm going to be mostly facilitating it, but let's just start with this first slide. I wanted to put together some simple pros and cons, the financial pros and cons of owning a home. The first is, as you all have known, we're at historically low interest rates. They are going up a bit and will continue to rise, but still, when you look back in time, it is unbelievable the rates that you, especially if you're a good qualifier, the rates that you can secure. These are still historically low times. Owning a home is a way to build equity at historically low interest rates. The other issue is that rents are rising. Rents have been rising. And so when you own, you're not at the mercy of a landlord raising rates. Obviously, when you own a home, you can make it your own, right? You're not in somebody else's home. And the tax laws have changed over the past couple of years. So in some cases, you may be able to still benefit from a tax deduction for the interest rate you pay on a mortgage and the property tax. But you may also be in a situation where the standard deduction on your tax return is greater than the mortgage interest, so that you wouldn't get a tax deduction. And you may be in a state where your state income tax is so high that it is more than the property tax deduction. So it's always good to talk to a financial advisor or a financial planner to see, is this something that you can benefit from? Now, let me also talk about the cons of owning a home. Price depreciation. Sure, over the long run, housing prices, the stock market go up over the long run, but there have been cases in recent history where if you have to sell a house when the market's down, you can lose money. Some people, when I'm working with clients, we have to really understand what is the total expense of owning a home. It's not just the principal and interest on the mortgage. It's the homeowner's insurance. It's the property tax. There's maintenance in a home. I know I'm in a townhouse that was new construction. I've been here 17 years. And let me tell you, in year 15, things started breaking down, and it's really hard to budget for those things. You also want to think about if you are buying a home, there are fees involved. So I always ask people, do you think you're going to stay in this home for 2 years, 5 years, 20 years? Because that goes into the calculation. And then the last con is that if you're thinking of buying a home as an investment, Well, there's pros and cons, but one of the cons is liquidity. Whereas in the stock market, if you invest money within 2 days, you can get your money out. Can't do that quite quickly with a house. You can't get your equity so quickly. So with that, let's get into the meat and of the presentation. And we are going to take questions at the end, please. So please chat them in. We know we're going to stimulate lots of questions. So I really want to bring Debbie into the conversation here. She's the expert on what is needed to qualify for a mortgage. So Debbie, please walk us through some of these issues.
Absolutely, and it's a pleasure to be here. It's a pleasure to share my 37 years of mortgage lending experience. Every situation is different. Everyone has a story. And as a loan consultant, what I need to be told your story. I need to be told if you, starting with number one here, do you have any idea what your credit looks like? Okay. If not, it's one of the first things you need to check or have me check for you. Are there issues related to credit that we need to work on? We have nowadays, it's fantastic. We have software programs that are available to us that show us what might need to be done to increase your credit scores. And the higher the credit score, the better your financing, the more competitive, the lower your interest rate. Number two, qualifying income. This is all part of your story. I like to start with credit, and then we talk about what you do for work. If you have been out of the workforce, which I've encountered this many times over the years, are you capable of going back to work full time? Did you have a career that you left for a few years? Part-time employment and seasonal employment are not always conducive to helping you qualify for a loan. And I see a question, Lori, should I just wait till the end?
Yeah, let's wait till the end because we've got a lot to get through.
Okay, so your work history is important. A lot of people are under the belief that, let's say you're a W-2 employee, you don't need 2 years at your job to qualify. You need 30 days of paycheck stubs and a full-time job and a guaranteed either hourly or guaranteed salary. So your qualifying income becomes very important in the whole package. If, and Lori and I will be getting into this more in depth next week in part 2, if you don't have the income, but you have assets, this leads us to number 3. Not only how much can you put down as a down payment, but can we get your assets to work for you? Let's say you've been given a settlement of retirement accounts or related to number 2, support. These are things we'll get into next week as to how we use those factors in qualifying. And in terms of a down payment, it really depends on what state you're in and your price point that you're looking in. Every state has their own minimum down payment programs. For instance, here in San Diego, where Lori and I are based, I often work with first-time home buyers, and you can either put no money down on certain first-time home buyer programs, or you can consider a government-insured loan, such as FHA, which requires only 3.5% down. Part of the down payment scenario, we are going to break down in more detail next week, because there are ways of obtaining down payment funds from family and close friends, and that's called a gift. Low debt level. Is it better? Are you better off paying down your debt, paying off credit cards before you purchase, or is it more important for you to put money away? There's no right answer to that. It depends on your individual situation. And that's something that You just can't plug it into a program and get an instant answer. Again, everybody's situation is different. We put together basically a book, which is your loan package, that tells a story about your credit, your income, your employment, your debts, and assets. How's that?
Love it, Debbie. It's a story. It's a story.
It's a
puzzle.
story. And then we, in part, to put everything together, all of the documentation, and we submit it to an underwriter who is then going to read and analyze your story.
Great. All right. So we actually had a question that you might answer about how high does the credit score do you need, and how can you improve it? How quickly? What goes on here?
Okay, credit scores have become such an integral part of the process. It's kind of a mixed blessing, okay? Because 20 years ago, before credit scores
money
were
to
even,
Nigeria.
pardon me? Oh, Lori, thank you. Several years ago, before credit scoring became a thing, there were other factors that were viewed upon in terms of approving a buyer, okay, or approving somebody who wanted to refinance. Nowadays, we have a pretty varied range of credit scores that we can fit you into a program. For instance, FHA and VA financing, where you're using your VA benefits. My company requires a 580, absolute minimum. But if we are dealing with a lower score like that, I would consider that C credit probably. We need other factors present, okay? And so 580 would be the absolute minimum. Many banks, many credit unions will not even entertain a credit score around 580, and they'll require 620. Now, Fannie Mae and Freddie Mac, who we sell directly to, the agencies, quote unquote, require a 620 credit score, okay? When we get into the higher loan amounts, i.e. jumbo loan programs, we need higher credit scores even, i.e. 680 and above.
And when you say about jumbo, with the jumbo loans, because in different states, real estate's more expensive than others. So is jumbo loan a finite amount no matter where you live?
Jumbo loans are a whole different animal. And I think, Lori, we might want to expand on that next week.
Let's do that.
Because there are, believe it or not, low down payment options on jumbo loans. So just knowing what's available will equip you with the initial information you need to plot and plan, to strategize. Okay. Now let's go to number 2 here. Do I mind repeating those scores? Not at all. Okay. Bare minimum, FHA 580. FHA and VA is 580. A conventional loan, one that is done through Fannie Mae or Freddie Mac, we like to see a minimum of 620. Now, lenders use credit scores based on 20-point increments in terms of determining whether you qualify and what your final interest rate will be, i.e. 620 versus 640 versus 680, and so on and so forth. If you have a credit score of 740 or 760 or higher, you're good to go in terms of credit score. That would typically qualify you for just about any program out there. If you think you need an 800 credit score, which very few people have, you don't need it. 760 and above will typically get you the lowest rates at the end of the day.
Debbie, when I work with a lot of women who are, and we'll talk about this next week, but who are going through divorce, they tell me their credit score is incredible. It's over 800. The great credit score alone is not going to guarantee you a mortgage. And we have to talk about that in our case studies. But, I have these women saying, my credit score is so great. How am I getting turned down? My credit score is so great. So I just want to make that clear that it's just part of the puzzle.
Yes. And if I could just interject right now to Wen Lee to answer your question, if you pay off your credit cards every month, you should have a pretty good credit score because you're not carrying balances beyond 30 days. So I hope that answers your question. Okay, how quickly, oh, Lori, can you backtrack just for a minute? I'd like to touch on number 2 there. How quickly can you improve your credit score if you need to qualify? We have a process that I've utilized for years called Rapid Rescore. And let's say I pull your credit and you are at 620, but there's a first-time buyer program, for instance, not FHA, but a lot of our down payment assistance programs that we work with require a 660 credit score. Okay, I can use a special program which will tell me what you need to do to have higher credit scores. Now, typically that involves paying down debt. And paying down debt typically, and Lori and I will get into this more in session 2, involves having your balances 50% of the high credit limit or less. So this program that I use, the algorithms will basically analyze everything and will make recommendations. I then go back to you and say, okay, these are the things you need to do to improve your credit scores. Are you able to do that? If you are, you will pay down your debt. We collect updated documentation from the creditor, and most companies, most direct lenders like mine will pay to have you rescored. And it takes literally 2 to 3 days. So the process, I like from the first conversation I have, it could be a 2 to 3 week process if we need to rescore, because there's work you need to do, there's work I need to do.
Wonderful. That gives everyone some hope.
Yes, I can tackle just about anything. Okay.
All right. So yeah. So I mean, the mortgages, there's so many. It's so interesting too, because with the interest rates that were really low for a while, now they're going to start rising. I mean, what are all the types of mortgages, and how do you know what's best for you?
You know, there are so many programs available nowadays, even compared to a few years ago. Programs are back. The economy is healthy. Underwriting has become a little more common sense. With COVID, for instance, we had what are called overlays in lending, and they affected many people who are self-employed, who had to provide additional documentation. That could apply for a number of these types of programs you see on the screen. I primarily work with conventional, the first 4. Conventional and jumbo are a big part of what today's home buyer uses. On your first-time buyer segment, it could be more of a government-insured loan. Let's say you have a lower credit score, lower credit score and a low down payment. You might be a perfect candidate for FHA financing. Fixed rate versus adjustable rates versus interest only. Most people nowadays will opt for a fixed rate loan. Even though fixed rates have increased about 0.75% over the last 3 months, they're still very low, as you said. And so very few people will opt for an adjustable rate loan. They're out there, and we can also entertain an interest-only option, which provides you with a lower mortgage payment, but those programs are primarily designed for the jumbo home buyer.
Got it. All right, we'll get into this more next week, but just want to make sure people understand. See, it's not a just easy thing. There's a lot of types to consider, and again, having somebody like you, Debbie, has had over, what did you say, over 30 years of experience?
Yep, 36.
And every interest rate environment, by the way. So
exactly.
Okay, so now let's get into some of the weeds here with some issues to consider. so it was interesting to me, Debbie, because I didn't even know this, that I thought I could just go to Credit Karma or go to the credit bureaus and just see what my score was. And you say it's different. There's different than the mortgage score is different than what I as a consumer might get. Please explain that.
That's correct. And it's Credit Karma and Discover and Capital One and all these companies that provide you with a free credit score. The variables that go into generating those scores are not what are used by lenders for a mortgage. Mortgage credit scores are rendered differently, and I honestly don't know about the whys and wherefores. But a mortgage credit report is typically going to provide you with the most accurate numbers to work with on credit scores. And it is considered a hard pull on your credit, but that hard pull is valid for a minimum of 3 months before we have to look at credit again.
And doesn't affect your score that much.
No. But it is a necessary evil. So I typically encourage my clients to allow me to pull their credit, knowing that we're going to be working on it or working with it for the next month or two.
Great. So you mentioned this earlier, and this comes up a lot with my clients where I'm working with women who were stay-at-home parents. They're getting a divorce now that the kids are going off to college. They want to stay in the marital home, and we're looking at refinancing. And I was surprised at what you said about full-time work versus part-time versus, so tell us a little bit about that, and we'll get into it more next week as well.
Yeah, so again, if you have a full-time salaried job that pays you a W-2, that in the eyes of the lender is considered the most stable type of employment. Okay. If you have a part-time job or you've decided to open your own business, you are then considered self-employed if you have opened your own business. If you are self-employed, the qualifying criteria are more strict, and we will look back at 1 to 2 years of tax returns to analyze your income. And with a self-employed buyer, your qualifying income is based on more of a net income after expenses versus a W-2 employee where we can base it on gross income. So part-time work, just keep in mind, it requires a 2-year history in that same line of part-time work.
Thank you. So I think the third point is pretty logical. If you make a higher down payment and you're borrowing less money, perhaps that's going to, guide towards a lower interest rate, but probably not necessarily, right, Debbie? What are some of the thoughts to think about?
Yeah, down payment, the down payment dollar is directly related to the interest rate in most cases. So let's say you're going to be coming out of a divorce and you receive a lump sum settlement that you want to use as a down payment. I often have women come to me and ask me, okay, Debbie, I have this chunk of change that I want to use for my down payment. How is that going to affect my interest rate and my monthly payments? Typically, we have several options that we will look at. And when it comes to down payments, those are done in increments of typically 5%. So with a regular Fannie Mae loan, for instance, 5% down, 10% down, 15, 20, and so on and so forth. So there's not just one interest rate. That's the main thing to remember.
Interesting. So on point number 4, and I mentioned this earlier, considering you've got to really consider all monthly expenses, not just principal and interest, when deciding how much of a home you can afford when you're going home buying. Let's say you're looking at a new home, and I frequently the message I hear from my clients, the ones who again would like to stay in the marital home during a divorce and need to refinance that mortgage in their own name, they will say to me, and their justification will be, Well, it costs just as much to rent as it is my mortgage payment, okay? Because they're trying to justify that renting, it's less expensive to be in the house. And again, it's my job to make sure you have no unwelcome surprises. Property tax. Is property tax going to increase over the years? Do you need a new roof? I mean, things cost money in a house. What if there are things that's going to happen, unexpected things, maintenance of the house? So they don't like it when I'm the tough cop, but to be successful in my job, I want to make sure that my client is not going to have to sell that house before she's ready because she did not calculate the total expense.
Exactly. And this is a big part of what you and I do, Lori, in helping analyze someone's financial picture. Does it make sense for them to pay off debt knowing they're going to be taking on a house payment, taxes, and insurance? Or can they afford to carry that debt? Again, every situation is analyzed on its own merits.
And that's what we have in the next point, that you're going to be helping them look at their student loans if they have it, whether it's for themselves or for their children. Maybe they've taken out loans for their children. Yeah, it is frustrating that there's no easy ratio or answer, but as you said in the beginning, every situation is different. You want to analyze it on a case by case basis. Anything on these issues before we go to the next slide?
No, I think next week we'll get into, on our case studies, we'll talk about student loans and credit card debt a little further.
Okay. So common mistakes that people make, and I only put, some of these, I'm sure there's more mistakes that I haven't considered. But, tell me, Debbie, why, you keep saying it's so important that you need to know your credit score, your credit history. Tell me why. Why is it terrible not to know that?
Well, because you might be under the guise that you have perfect credit, but maybe you haven't been the one paying the bills all these years, and your spouse or your significant other has. Some people who come to me are pleasantly surprised when I check their credit and the credit is better than they thought. But many people over the years who I've worked with, they have no idea. And then I pull their credit and I look at it and I'm like, wow, did you know that your mortgage, let's say, was late a couple of times? That can really be tough to work with. Okay. We need to explain late payments, collection accounts, things like that. So credit scoring, because it's such an important part of what we do in terms of making loans, just being aware of it and knowing, working with a professional who will help you increase your credit scores if need be.
So I learned this the hard way, not paying bills on time. So as I told Debbie, as we were preparing for this, my husband and I have had a mortgage, for years. We have a couple of different mortgage lenders, but when I don't know if we were switching, I think it was our credit card, the debit card changed or whatever. But the point is we had automatic payments set up, and 1 month it just didn't get paid. I don't know what happened. Of course, I blamed him. I screamed at him, and somehow he got his credit score improved. Mine stayed I was over 800. And then after that one missed payment, which was probably more than 30 days late because we didn't know about it till it was too late, my credit score went down below 700. I was in the high 600s, and it took a couple of years for it to get back. And just so can you talk about even just being late 1 month? Because we talked about maybe there's a 15-day grace period or.
Yes. Having a late payment, first of all, so let's talk about grace period, typically on credit cards and mortgages. Typically, and again, it will depend on the creditor, you have a 15-day grace period. Again, check with your individual creditor for the rules on that. So you will not be assessed a late fee, okay, if that payment is made within 15 days. Now, let me direct this towards a mortgage rating because I know that. If you allow your mortgage to be 30 days late, it's very, very bad. Okay, it's really hard to overcome it. it's really, it makes it very challenging for somebody like me. Let's get back to credit card debt. If you have 30, 60, or 90-day lates, the longer it's late, i.e., 60 or 90 days, the worse that will be for your credit scores. Okay. And interesting, we look at first the most 12 months history on your credit cards and installment loans. And then we go to 24 months. But the most credence is given to the past 12 months.
Oh, your most recent history. That makes sense.
Yep.
Right. Yeah. So you could have a great history of being on time, and then in the past 12 months, something like what happened to me happened, and there you go. Yeah.
Yeah.
Okay, now, it's interesting. People ask me about, should I have more credit cards, or should I have a car loan? Does that improve my credit score? What about if I'm going to try to qualify for a mortgage? And I think you mentioned something about a 50%. You don't want to use more than 50% of available credit.
That's correct. And let me address okay. So are you talking about the third or fourth bullet point?
Oh, I was actually on third. Yeah.
Okay. Okay. So keeping your balances at 50% or below is really important. Okay.
And
Or
below what? The available credit line?
yes. Yes. So if you have $1,000 credit limit, make sure you keep your balance under 500. That's a kind of a loose rule of thumb that we use in the business. Okay. Sometimes, now here's the opposite. Sometimes somebody will come to me and they won't have any credit. So there's the opposite situation where I will say to them, okay, I've run my special program, I've waved my magic wand, and guess what? You need to go out and apply for a secured credit card. You need to apply for a department store credit card. Start utilizing it, charging on it, and paying it back. Okay. So paying it off. Many people over the years have come to me with a very limited credit history, and that can hurt your credit scores.
Right. Okay. And we just have about, I think, 5 or 7 more minutes of slides, and then we'll take questions. I've seen questions come in, one on this subject. Okay. And then I think just, people who need a new car, or big purchase, or, I guess this is just a case by case basis.
Yeah. Just tell me what you're thinking of doing. Don't go out and do it and then let me be surprised. Okay. Your loan officer does not want surprises like that. Let's say you're in escrow to buy a property and you don't think it's really going to make a difference if you take on a new car payment. Well, guess what? It could cause your loan to be declined.
Unbelievable.
If it's
That is so
determined,
scary.
yeah, I mean, it's very serious. You need to treat me like your therapist and tell me what you're thinking of doing. I will let you know if you can afford to do that or not. Or I might say, you know what? Just wait until after you purchase. There's no need to go out and buy furniture. There's no need to get a new car right now. Maybe pick up a little used car somewhere, borrow a family member's car. You'd be amazed at the car payments I see. It's crazy.
Very good advice. Very good advice. And I think this just means, have a strategy. And I love, Debbie, how, treat Debbie like your therapist, and no question is stupid, right?
Nope,
The more you
absolutely not.
The more you can help. Got it.
Yes.
Okay. Excellent. And I think we already talked about a little bit about paying your monthly mortgage on time. But what I thought was, helpful, we've had, a spouse loses a job, you lose a job and all that. And, we've had, I know with COVID and stuff, there were deferred I mean, I don't really even understand the difference between the forbearance and the deferment or the loan modification. Can you briefly talk about those?
Yes, and these are not my specialty, but I've been somewhat involved in them over the years. A deferred balance is, and I have a client I'm working with right now who went through this. Because of COVID, her income was affected, and she contacted her lender and asked for them to lower her payments. So in essence, it is a type of loan modification. So now this gal has come to me and wants to refinance. Well, guess what? The 40,000 that she deferred now has to be part of the payoff. It's not just the regular balance, it's they tack on the deferred amount. So be cautious with that. Again, this is not my specialty, but there was a time several years ago when we had the mortgage meltdown where a lot of people had loan modifications. It is negative on your credit. Okay. There are ways to work with it, however. So again, each case is individual.
And this is again why, as a financial advisor, it is my job to help you as a client forecast these things. What would happen if you are you relying on both your incomes, you and your spouse, to afford this mortgage? What would happen if there was a loss of a job? Do you have an emergency fund? Do you have 3 to 6 months worth of money to pay the mortgage, to pay the things that must be? Because Debbie, what you've told me here is that now I've learned this, that the most important bill to pay among all the other bills is the mortgage.
Absolutely. A
The
mortgage
credit card,
late,
I can
yeah,
pay interest, have late fees, the medical, I can call them and do,
absolutely. And I think next week, Lori, we'll talk about collection accounts and how medical collections do not affect your ability to get a loan in most cases.
Oh, good, because we got a question about that. Okay, so we are, so this is, I think, a very important slide. I wanted to include this because, I have so many clients that say, oh, well, my mortgage is with Wells Fargo or Bank of America or my credit union or whatever, and I'm just going to go back to them and see what they offer. And there are other ways to obtain a mortgage, not just the bank. So if you can talk us briefly through the 3 major ways.
Absolutely. And I've worked for all 3 over the years.
Oh, good.
Yeah, so I can speak to all of these. So a bank is, you're going to work with a loan officer who only offers their programs. Banks tend to be, in many cases, more conservative in approving loans. Okay. I had somebody come to me a couple weeks ago and she wants to buy a house and get a pre-approved. And the bank told her that she had to have 5% of her own money, and then she can get, her mom wants to give her a big gift to buy a house. Well, I don't need you to have 5% of your own money. So as a mortgage banker, I fall into category number 3. We can allow all gift in most cases. A mortgage broker, I was a mortgage broker for 12 years, and this was several years ago, gave us the ability to shop the loan to different lenders. Okay. Now, mortgage brokers were more popular and widely used about 12 years ago, 15 years ago, when a lot of people were looking at adjustable rate loans, when we had stated income loans, we had a lot of interest only loans. So we had a whole plethora of lending sources to go to. What I do now as a mortgage banker is I have the ability to do pretty much what the other 2 do, okay, on a national level. So my company is a non-bank lender. We are a mortgage banker.
And that means that your company can provide loans to anybody living in any state in the United States?
Yes.
Okay.
Absolutely.
Right. Okay, so we're going to take questions here, but I wanted to include our contact information. There's Debbie, there's me, and let me see, Tracy, if you're there. I don't know if you've been going through the chat. We've been answering some of the questions as we go along. What's the best way to make sure we didn't miss any?
I think that you got most of them, or said that you were going to cover them in the next session.
Okay, because
yeah, I think as I was going through, I think that let me just double check.
Because I can't see the chat right now. I don't know where it went. Oh, here it is. Now I have it.
One of the first questions, will we be offering a copy of the PowerPoint?
What do we, will they be able to maybe see I think if they see the webinar video, they'll see
Yeah, they'll be on the recording.
Yeah, they'll be able to see the PowerPoint on the recording probably. And we talked about the credit score. Somebody thanked you for the lovely explanation about the mortgage process. Oh, is the software you use, Debbie, available to the public for how you can improve your credit?
It's not. It's not. So we work with a credit company, which all lenders do, and banks. I utilize their software to determine what we need to do to boost credit scores. It's proprietary.
Okay, and then somebody asked about the difference between the FICO score and the credit score.
FICO is, so there are 3 credit scores. There is TransUnion, Equifax, and Experian. We refer to them as FICO scores, which is initially that was started by Fair Isaac and Company. But in determining how you qualify, we will use the middle credit score. Okay. So let's say you have one at 620, one at 625, and one at 630. We're going to use the 625 credit score for qualifying. So it's all about the mid credit score.
Okay. We never explained this. I think this is good to explain. Can you explain the escrow process?
Yes. So I saw somebody ask, what is an escrow account? An escrow account is an account that your lender sets aside to pay your property taxes and homeowners insurance. It could be one or the other, or it could be both. And I typically advise my clients to establish an impound or escrow account because the lender pays those expenses for you. You pay into that account 1/12 of those expenses every month so that your property taxes are always paid and your insurance is paid. Taxes are typically paid twice a year. Insurance is typically renewed once a year.
Okay. And I don't know if she meant, so I didn't know if she meant the escrow or the escrow process when you're going through the house, buying the house.
That is a whole nother conversation,
Okay.
Lori. I think we can touch on that next week and do a case study.
Great. So Tracy, we're 45 minutes in. Should we take questions just for a few more minutes? What's the?
Absolutely. If you have questions, you can go ahead and put them in the chat. If you'd like to raise your hand, that's something else we can do, and you can unmute yourself.
Oh yeah, we can take them live.
Yeah.
Chat or verbal.
I do see one question here. I think we may have addressed it, but I'm not sure. What about if you have many credit cards you don't use as much, or that have been paid way before the credit card charge interest, meaning less than 30 days? Will that affect your credit score also?
That's a really good question. And the first part of that I want to address because I will rarely advise a client to close a credit card. Okay. Credit scores are generated on how much available credit you have and how well and how timely you make those payments. So sometimes people will assume, I don't use these credit cards. I don't need all these credit cards, so I'm going to close a few accounts. Well, guess what? It could actually lower your credit scores because you're now diminishing your total available credit.
So let me add on to that question. I know that sometimes, let's say you have a department store credit card, and if you don't use it for a year or two, then they close is that going to be negative?
It's hard to say because I think it depends on the rest of your available credit, honestly. Yeah, I've seen that happen.
All right, so here's another one. Given the high prices in the market right now, is it a good time to buy?
All right, I'll take that first. Debbie's going to punt it to me anyway. Okay. like we said, case by case basis. I mean, look, let's talk about the elephant in the room, right? Housing prices have skyrocketed in many, if not most, parts of the country. Do I have a crystal ball? No. Debbie doesn't have a crystal ball. Real estate prices could continue to rise. We could have a correction. We've looked at history. It's no different than the stock market. They could go up, they could go down. And so knowing that anything can happen, what I like to do is to do potential scenarios with my clients. Okay, let's see if you were to rent for a year or two and housing prices were now 10% higher. What if that happens? What if they're 10% lower? What if they're flat? I mean, the best way to do this when we don't know the future is to forecast maybe 3 different scenarios and see if that impacts your choices today. Debbie, do you have anything to add to that?
You know, depending on where you live, it could be a good time to consider buying depending upon the supply and demand in your area. Unfortunately, where Lori and I live in San Diego, it's a very cutthroat market and it's very challenging because we have so many buyers out there with not enough properties for sale.
And I would add, again, this is about what is your short and long-term goal. If you're only going to be in that house for 3 or 4 more years, how are you going to feel if this the market stays flat or goes down? If this is going to be a 20-year home purchase, then maybe it doesn't really matter how much it costs today, especially if you want to consider that interest rates will likely be higher in the future. So
That's
these are the
correct.
types of things we just have to analyze and assess. Somebody asked about the rescoring of credit. She said, can you explain rescore credit again? Maybe that's what, maybe that was the process you rescore, yes.
Oh, okay. So I'll just briefly explain the process again. I pull your credit and I then see that we want to get your scores up, let's say 20 points so that you can qualify for a given program. I then run a special software program that will recommend which accounts need to be paid down, or let's say there's a non-medical collection that needs to be paid off that you just let go for whatever reason. My results, I email to my clients as recommendations, and then you can decide if you want to take action on that. And let's say pay down that credit card. Give me an updated statement, and then I submit it back to my credit company, and it's a permanent rescore. Really, that's the simplest way to explain the process.
Excellent.
It involves a little bit of work on everyone's part, but it's a proven program. I get great results.
Terrific. All right, so I think we'll forecast what's going to happen next week on this part 2, and a couple of the issues we're going to discuss is one that I'm heavily involved in the divorce process. When one spouse wants to see if she or he can qualify to stay in the marital home and refinance the mortgage in their own name, we're going to talk about how does this work? Does the spouse do a quit claim, interspousal transfer? What's the timing of these? One of the issues that I work on a lot is helping to craft child and spousal support situations where some of that income can be used to help you qualify for a mortgage. There's rules and strategies around that. Debbie, any other, off the top of your head, any other issues you think we might be discussing next week?
You know, I think, Lori, you and I will put together a few case studies to discuss, and that will give everyone in the audience some real-time examples of what we work with on a daily basis.
Terrific. Okay, so last, somebody asked, what is a CDFA credential? That is Certified Divorce Financial Analyst. CDFA Certified Divorce Financial Analyst. It is somebody who's been trained on the financial and tax considerations in divorce. And we have Tracy. I'm going to take it over to you to talk about the helpline.
Wonderful, thank you. So for those of you who aren't as familiar with Savvy Ladies, we offer a one-on-one pro bono financial helpline where you can come and ask your financial questions, and we match you with either a CDFA or a CFP, certified financial planner, or if you have questions with banking or mortgages. We also have, just like Debbie, we have people that specialize in that. They can help you. So it's confidential. You're matched with a professional, and it's a safe space. We don't sell products or services through the helpline. And don't be embarrassed about mistakes that you've made in the past financially. I may have made a few, and I'm sure most of us here can say that. So it's a safe space for help. And we put the URL in the chat. It's also there on the slide. If you have any questions, you also can just reach out to me directly. And I think that that's about it. If anybody else has one last question before we sign off.
And both Debbie's a new helpline volunteer, and I've been volunteering probably for 6 months or so, I think. And here's the registration for the the session next week. Okay, well, just want to thank everybody for attending. Thanks, Debbie, for her time. Thank you, Tracy, for hosting Savvy Ladies.
Wonderful.
And we'll see many of you next week.
Absolutely.
Thank you,
Thank you so
everyone.
much, ladies. Have a wonderful afternoon.
You too, and it was our pleasure.
Thank you.